Hello, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. I want to welcome everybody to the Daily FX Walkthrough. Going to get started in just a moment. What I'm going to do tonight is walk through the latest technical report by Jamie Setley at DailyFX.com. So let's go ahead and pull up that report and read the synopsis on top. The euro-dollar is at its lowest since March 2007 with volatility down significantly from last week's levels. Be wary of a false breakdown. So let's see what he has to say more specifically about the euro-dollar. Euro-dollar is extremely weak, remaining below 135.35, keeps the extremely bearish count shown above on track. And if you recall yesterday, I was mentioning that spike low of 32.57. I was personally expecting that low to hold. It looks like it was holding, but then we had the move beneath it. I exited my position there on the close beneath that level, and right now I'm just honestly waiting to see what's going to happen and personally keeping up to date with Jamie's reports to see if he sees anything before I do. And now down to the dollar yen, as that's what I have been focusing on lately here with my reports. If I'll read the synopsis, continue to favor the downside as long as price is below 103.10. This keeps the longer-term bearish count intact, in which the dollar yen will accelerate lower and drop below 95.72. A push above 103.10 targets resistance from Fibonacci at 104. Price ideally remains below 102.46 for now. So let's go ahead and pull up the charts. And the first chart actually is the pound-dollar chart that I was showing you yesterday. And if you recall, during yesterday's report, prices were just about here, and I was mentioning to maintain a slight bullish bias against that low. And I just wanted to take this opportunity to show you how to properly exit trades in case your analysis is wrong and prices move against you, because if you stick around long enough, I guarantee you that will happen. So let's zoom in, and again, I'm focusing on the 61.8 level, which I personally was maintaining a slight bullish bias against, and I was mentioning this as well, and that these are very short-term levels, and we have to be able to abandon our analysis as soon as we see a break or a technical violation, which is what we had here. And if you recall, yesterday we were right at this candle right here during the report. There were a few more pips on the upside there for shorter-term scalpers or something like that, but then we could see later on, and I believe this is between the hours of 3 and 4 a.m. Eastern Standard Time, we had the close beneath the Fibonacci level. And let me zoom in really close here to give you just a better view. And once we had that close beneath the 61.8, which is right here, that would be the time to exit the trade on the clear close beneath. Now, obviously, that's only about 10 to 12 pips there. Waiting for the next candle, that's a dangerous thing too. And also, the time of day is very important. Typically, large moves do occur between 3 and 4 a.m. And we can see if we did wait for the close of that second candle, we're still out at a decent price level. Considering what happened after that is a complete collapse in the currency pair. And what so often happens, and why in the FX Power Course we urge traders to trade the longer term charts, is because this is a shorter term trade that had you held on to it, okay, and had you thought, okay, I was in a shorter term trade, but now prices have broken beneath the Fibonacci level, the basis for my trade, but I'm going to hang on and turn this into a longer term trade. And we can see what happened, and I bet there were a lot of traders out there who had that same mentality, the pair, falling nearly 500 pips after that point. And that's something always to keep in mind, is that when you're doing a short-term trade, you have to honor your stop level. In this case, that would be a close beneath that 61.8 level. And now let's go ahead and let me pull up the dollar yen. As again, this is what we have been focusing on. Jamie's been spot on in terms of the decline in the pair, the subsequent corrective rally, and the secondary decline that has of the impulse wave that has continued here. So certainly keep an eye on Jamie's reports each and every day. And we can see the short-term support line has been violated. That's a line that I would look for right now. Again, Jamie's very bearish on this pair. Look for this level to possibly act as resistance tonight. And what we might also do is wait that we have a simple resistance line as well, and I believe by about tomorrow these lines will converge, and that can offer an excellent area of potential again, potential resistance in the dollar-yen pair, setting up that short trade. And again, Jamie is extremely bearish on the pair long term, but we have to be careful short term to get the proper entries with the solid risk-to-reward ratios. Again, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. Thanks for listening.